All right, today we're going to dive into a really powerful tool for any investor, the bond ETF. We're going to break down how this one single investment could be the anchor your portfolio has been searching for.
You know that feeling, right? You check your all-stock portfolio, and one day it's soaring. You feel like a genius. And the next, it's taking a nosedive. That kind of volatility is, well, it's just stressful. But what if you could smooth out some of those crazy bumps?
Well, this is exactly where the bond ETF comes into the picture. Seriously, think of it as a source of stability, an anchor that adds some much-needed calm to the often stormy seas of the stock market. So, what exactly is it? To put it simply, a bond ETF is an exchange-traded fund. But here's the twist. Instead of holding a bunch of stocks, it holds a whole collection of bonds. These could be from governments, from big corporations, or, a mix of both. The easiest way to think about it is like you're buying a pre-made basket of bonds. So instead of you having to go out and research and buy dozens of individual bonds all by yourself, the ETF just packages them all together into one simple investment. And that built-in diversification, that is the absolute key to reducing your risk.
So how do they actually work? Well, in a lot of ways, bond ETFs really give you the best of both worlds. They kind of combine the classic stability we love about bonds with the modern-day flexibility of stocks. Let's take a look at how they pull that off.
Okay, this is a critical difference, so listen up. When you buy an individual bond, you know exactly when it matures, right? You know the date you'll get your initial investment back. A bond ETF doesn't work that way. The fund manager is constantly buying and selling different bonds inside the fund, so there's no single end date.
And this is where their flexibility really shines. You can buy or sell shares of a bond ETF anytime throughout the trading day, right on a stock exchange, exactly like you would with a share of, say, Apple or Amazon. This makes them incredibly liquid and just super easy to manage.
Okay, so not all bond ETFs are created equal. You've got a pretty fundamental choice to make, and it really comes down to your financial goals. Are you looking for a regular stream of cash flow right now, or are you more focused on long-term growth for later? The difference is actually pretty simple. A distributing ETF pays out the interest it earns directly to you, in cash. This is perfect if you're trying to generate some income. On the other hand, an accumulating ETF automatically reinvests all that interest for you, buying more of the fund. This really lets you harness the power of compounding to grow your investment way faster over time.
Of course, no investment is perfect. I mean, come on. So to make a really smart decision, we've got to look at both sides of the coin. Let's start with the major benefits.
And the advantages here are pretty compelling. You get instant broad diversification, which is just fantastic. They act as this wonderful stabilizing force in a portfolio that might be a little too heavy on stocks. And like we just saw, they can generate steady income. And that flexibility is a huge, huge plus.
It all sounds pretty great, doesn't it? But with any investment, there are always risks you got to consider. So, what's the catch? What's the main thing you need to be watching out for with bond ETFs? Here it is. Bond prices and interest rates, well, they have an inverse relationship. Think of it like a seesaw. When interest rates in the wider economy go up, the value of existing bonds with their lower rates tends to fall. This is the #1 risk you're taking on, especially when it seems like rates are on the rise. But here's the really clever part. Because the ETF holds such a wide variety of bonds, all with different maturity dates and from different issuers, that built-in diversification helps cushion the blow from those interest rate swings. Now, it doesn't get rid of the risk completely, but it for sure helps manage it. So, after weighing all the pros and the cons, how do you know if a bond ETF actually fits into your personal investment strategy? Let's get crystal clear on who this kind of product is really designed for.
It really just boils down to this. If you're an investor who's looking for more stability in your portfolio, maybe some steady income, and a good dose of flexibility, then yeah, a bond ETF could be an absolutely excellent fit for you.
This quote really just sums it all up perfectly. Bond ETFs aren't the most exciting, high-flying investment out there, but that's not their job. They're a practical, powerful tool for building a balanced, resilient portfolio that can handle all sorts of different market conditions.
And that really leaves us with a final thought. By understanding tools like this, you're not just picking investments, you're actually building a financial foundation. So the real question isn't just about bonds or stocks. It's, with this newfound stability, what kind of financial future are you going to build?